The recession is going to be worse than analysts expect, and the bottom is going to be lower than analysts expect. We could be looking from the current levels. Bear in mind, we're down significantly from January 1st, 2022. In the case of the NASDAQ, the turnaround actually started November 2021. So we're down from those levels that it could go down, easily go down 30%. And it wouldn't shock me if it was down 50%. You're looking at, S&P, 2,000, 2,100, something like that.
That would be pain. Do you see, given that this recession could be worse than most are expecting right now, there being, wide-scale layoffs of the sort we've seen in some of the bad previous recessions like 08, like 01?
The answer is yes. First of all, we're seeing it already. I don't match the company to the exact number, but layoffs on order of magnitude 10,000 to 20,000 terminated employees at Google, Amazon, Facebook, and other tech names. It affects other sectors as well, but tech in particular has engaged in a massive series of layoffs. And so people go, well, wait a second, how come it hasn't shown up in the unemployment numbers? Because the unemployment rate is it's around 3.5, 3.6 on the exact number. It's right in that neighborhood, 3.5, 3.6. We haven't seen that level of unemployment, that low, that is, since the 1960s. This isn't like, a good year or a good day. This is the lowest since the 1960s. And the Fed is absolutely looking at that. You're right about that, Adam. And they're saying, and of course, they believe in the Phillips curve, which is junk science. But the Phillips curve, for those who are not familiar, says there's an inverse relationship between unemployment and inflation. So if unemployment is high, inflation is low. And if unemployment comes down, inflation goes up. And so if you want to get inflation down, you should expect to bring unemployment up. That's what the Fed believes. What I just said is nonsense. It's not true. If you think of a matrix of unemployment and inflation, what did we have in the late 1970s? We had high unemployment and high inflation. What did we have between 2009 and 2019? We had low unemployment and low inflation. What do we have now? Low unemployment and high inflation. So as you can fill in every box in the matrix, which means there's no correlation. I mean, you can describe it, you can calculate it, you can put it on a chart, but there's no correlation. Last time I looked at the Phillips curve, it was flat. At least where I went to school, curves were curved. So it's junk, but the Fed believes it. Again, it doesn't matter what I think. It matters what the Fed thinks. So you got to put yourself in their minds to figure it out. So as far as they're concerned, those kind of unemployment numbers, lowest since the 1960s, that's inflationary. They got to get those numbers up. Inflation is coming down, by the way. And having said that, the target is 2%. So he's not there, but he's making progress. Now, Wall Street's saying, you're done. You did it. Mission accomplished. Inflation is coming down. You got what you wanted. Give it time. Stop raising rates. You're going to kill the economy. But the Fed is saying, well, we actually don't know. We can't untangle it. Yes, inflation is coming down. That's objective. But is it coming down because we're still raising rates? Or is it coming down because we're at the terminal rate? Those are two different things. And right now, and this is what Powell's been saying, the Fed leans to the view that they're not at the terminal rate, that inflation is coming down because they're raising rates. They have not achieved the terminal rate. So my expectation is the Fed will raise interest rates 25 basis points. That'll get you to 5.25. And even the more hawkish members think that that's probably the terminal rate. So Powell and the Fed have said, yeah, inflation is coming down, but it's because we're raising rates, not because we're at the terminal rate. We're going to get to the terminal rate, probably 2 more hikes, and then we'll pause. And then if we're right, we'll just let inflation come down on its own. And that may take a year. So all this stuff about the Fed pivot and cutting rates and all that stuff, I mean, the Fed's thinking mid-2024 before they do that. Now, Wall Street, and I'll say markets, not just Wall Street, but the big money in the Eurodollar futures curve and the U.S. Treasury curve, which are highly inverted, are saying, no, you're not going to get that far. You may be at the terminal rate already. You're definitely going to cause a recession. It'll be more severe than you think, and rates are going to have to come down sooner than people expect. In other words, you've already achieved the terminal rate. You just don't know it, and you'll probably be the last to know. So with Wall Street, with the cheerleaders, sending that message, but with some serious market indicators, including yield curves, sending that message. Why is Powell sticking to the game plan as I described it? And the answer goes back to 1980, believe it or not, and what's called the Volcker mistake. And everyone knows, Volcker became Fed chairman in 1979. He stayed on until the early to mid 80s. And he did raise interest rates to 20% or very close to it to kill inflation, which went up to 15% at the time. But people forget that there was a recession in 1980. It was sharp but quick. It was over very quickly. It had nothing to do with monetary policy. The Carter administration issued some dopey regulation on a ceiling on credit card interest rates. And the industry said, fine, we're just not going to lend anybody any money. The economy fell instantly. Because at a time when farmers around the country were driving front loaders and tractors to Washington, and they were circling the Fed building, and one guy drove his tractor up the steps of the Fed, and Volcker was being burned in effigy. That all happened. So it was a little bit of pressure. And of course, Congress was up in arms and the White House was up in arms. So Volcker, not quite panicked, but he cut interest rates 7 percentage points, not 0.7, 7 full percentage points to deal with the recession, which, number one, was unnecessary because the recession was caused by a policy blunder from the White House, which was quickly corrected. And number two, he had not won the fight against inflation. Well, after he cut rates and we came out of that very quick sort of snap recession, inflation got even worse. And that's when Volcker had to raise rates to 20%. And Volcker, in hindsight, he said, we shouldn't have done that. We should have stuck to our inflation mission. So now Powell, remember, Powell's not an economist. He's a lawyer. So he kind of thinks like a lawyer. I can relate to that, looking at both sides. Powell does not want to be that guy. He does not want to be the guy who balks early and cuts rates, the famous Wall Street pivot, before the battle against inflation is won, because the outcome could be exactly what Volcker experienced, which is inflation wasn't done, doesn't go away, comes back stronger, and then you do have to destroy the economy, as we did in 1981-82. That was the worst recession. That was far worse than the little one in 1980. That was the worst since the Great Depression. We've managed to break that record several times since then, but at the time that was horrific. But Volcker and others have said that was a blunder. He never should have done it. So Powell does not want to give up the rate hikes too early because he does not want to repeat the Volcker mistake. He does not want to be that guy. And that's what's driving him, even as Wall Street screams, you're already there. So the question is, how does this play out? In my view, Powell probably is there. He probably is at something like a terminal rate. He probably doesn't have to raise interest rates anymore. He doesn't believe that himself. His models tell him otherwise because they're relying on the Phillips curve, which is junk science. I mean, the last time I looked at a Phillips curve, it was flat. At least where I went to school, curve was curved. This thing is flat. There is no correlation between unemployment and inflation. There just isn't. But the Fed thinks there is. So I always tell people, if you want to forecast Fed policy and understand the Fed, don't think like a rational person. You have to think like the Fed. You have to get inside their heads or else you're going to get it wrong. So they're looking at unemployment, which is the lowest. The unemployment rate is the lowest since 1969. Well, if you believe in the Phillips curve, then that's a sure sign of inflation. As I say, even though it's coming down, it's still pretty high. They think they have to keep fighting this fight. Now, here's what the Fed is missing, or maybe everybody's missing. When you hear these layoff announcements, people are like, well, if they're laying off, why isn't the unemployment rate going up? Well, the answer is they have to announce the layoffs. There's all kinds of statutes, SEC, Warren Act.
Warren Act, yeah.
Yeah, exactly. So if I'm going to fire 10,000 people, I got to tell the world I'm firing 10,000 people. It doesn't mean I fire them that day. I might fire them on a rolling basis over the next 30 days. And it doesn't mean they walk out the door empty-handed and head for the unemployment office. I might give them 3 months severance, 6 months severance, et cetera. And so when do they actually show up to the unemployment office and say, give me a check? It might not be till this spring. So the layoff announcements are out there, but the unemployment rate hasn't budged because there is a lag, 3 months. But that's why I said interest rates lag the business cycle, and they do. Unemployment lags the business cycle. Unemployment is a lagging indicator. When you're an employer, entrepreneur, and you're in any kind of distress, not as many customers walking in the door, you'll do everything you can to avoid laying people off. You'll, be late on the rent. You'll turn down the lights, find a cheaper laundry, whatever it takes. And then by the time you get around to firing people, you run out of options. Like, I've done everything I can. Now my business is in jeopardy. I have to fire some people. So that, and then combine that with what I just said about severance and, rolling terminations, et cetera. It's a lagging indicator. But we know enough right now here, kind of in early, late January, early February, we know enough right now to know that number's going up this spring. But that's not inconsistent with the fact that we're already in a recession. It's exactly what you would expect, that unemployment's a lagging indicator. Now, having said that, what else is the Fed missing? Well, By the way, Adam, you mentioned wages or the salaries. Wages are up 5% on an annualized basis, 5.2% on an annualized basis. I'm like, yeah, and inflation's 7% or 6%. So your real wage just went down 1 or 2 points. Because when the Bureau of Labor Statistics reports those wage numbers, those are nominal numbers. I'm not saying they're fake, but you have to know that they're nominal, and you have to subtract inflation to find out what's happening to real wages. And the answer is real wages have been going down for a couple of years because it runs around 5% annualized, give or take. Sounds like a 5% raise. What do you want? Well, yeah, but with 8-9% inflation or even 6% inflation, your real wage is going down. So that's not a robust number at all. The Fed, by the way, the Fed wants to make it worse. The Fed agrees that those wage gains are too high. But my point is, in real terms, they're actually going down, but the Fed wants them to go down more. That would be one way to put it.